All right, we live.
All right, what's going on, guys?
You know,
Girls, too.
there's another beautiful day in the neighborhood of mortgage and real estate.
Yeah, another great day in real estate, and mortgages. So, how has life been the last week? We didn't come on last week, so how you guys been doing the past week?
Mr. Abraham, are
Oh
you
no,
gonna
I
answer
mean
that?
for
Or
us, I
you want
mean
me?
honestly, we're doing pretty good. We just
Okay,
came off one of our strongest months, in the business. So
that's
people
awesome.
definitely buying homes. People are definitely getting financing, and regardless of what anyone tells you is going on in the market, it's still maybe volatile, but it's homes available, and people are still making the American dream there. So don't hesitate, join up.
Yeah, yeah. I mean, people buying and selling every day now.
Yeah.
I mean, is it the market? The market still is pretty hot, I believe. The only issue I'm seeing right now is inventory. Having enough properties in a certain price range for clients. That is the challenge right now. But we're still being able to make it happen for clients that are able to get a pre-approved. I was speaking to somebody about that the other day, actually, and we were talking about, hey, should I get pre-approved right now? And I was like, yes, you should. I want you to be ready, because if you find the house you love, I don't want you to be, struggling trying to get all your paperwork together, trying to get it to your lender. Now you want them to get all your stuff together real quick because you don't want this house to, slip from under you. I told her, I said, your best bet is to make sure you're ready to pull that trigger, okay, when you find that house you love. So, but
Yeah, I totally agree with that statement. Just because exactly what you're saying. Because sometimes if you wait till the last minute or you wait until you already found a house and you haven't been pre-approved, I mean, you don't really know, what you may need or what you really will qualify for, or if there's anything that you might need to work on. So already going through that process so that you can, like you say, you can be ready when it's time to get ready.
oh man, I hate to go down a rabbit hole, okay? But you brought up a good point. Like you do not know. Like you could be very confident that, hey, everything is, A1, right?
Hmm.
But, you might be thinking that, hey, I can afford this $350,000 house because you got approved last year. But let me tell you, interest rates have changed,
That's
you
right.
Yeah.
know. So I don't want people to get excited, and then you try to get pre-approved. Now you realize your buying power has decreased, you know, and that I have seen that a lot lately. So,
Yeah,
but
and honestly, that's real talk, and it happens, more often what people think is because a lot of times, like you said, people may think, oh yeah, I can afford, in my air quotations, I can
Hmm.
afford this, but just because you can afford this may not be what you can qualify for, because those are two different things.
Yeah, you just
preach,
gave a word right there.
preach, afford and qualify. Ooh,
Right.
that'll go in. That'll preach right there.
Yeah. No, I
What can
mean
you afford and
just
what can you qualify for? It's two different things.
right, because I got a guy right now who he can afford, a $200,000. I mean, a $2,000 payment, monthly mortgage payment,
Mm-hmm.
but he don't qualify. It's just simply because you got your, of course, your self-employed people. You want to write off as much as you can on your businesses and things of that sort. Yeah, you bring in 100,000, but unfortunately you reported to the IRS that you only you know are bringing in 25,000. So I know you can afford it, but you
Mm,
don't qualify for it, unfortunately.
I like that. That's a t-shirt right there. Um, I like that. But all right, we all right. So I know we got on this topic, but I want y'all to go into the topic that y'all want to talk about today. I know we discussed it earlier, so if y'all don't mind going into what topic we're going to go in today.
Yes. So what I think we were talking about. Let me get back to it. Talking about like city housing and versus rural housing, right? in regards to different loan programs and things that that can benefit you, and not necessarily even pros and cons, but just the differences. I mean, we know that there are special programs out there for rural housing. It's an incentive to buy in these areas because, of course, they want to develop them. And USDA for is probably number one. Um, for that to help people with, 100% financing because normally in rural areas we have low to moderate income. Now
Yeah,
that's
I would
not to
also
say.
add to that,
Oh, go ahead.
and I didn't mean to cut you off, Gav. What I add to that, if you think about it, like I know, Wilmot, you're in the Orangeburg area, which is considered rural for now, but I think in a couple of years it's not going to be rural. And us here in Charleston and Somerville, the prices here has just skyrocketed. So a lot of people are wanting to move out of the city limits to your, Orangeburgs, Ridgeville, Hollyhill, um, you know, Bowman areas or whatever, because I guess you can say one of the pros is that it's a little bit more affordable. It's not as expensive to live out there when we talk about like just the sales price of the property itself. However, there is um, there is a lot more, I'll call it red tape to it, because sometimes in those rural areas, some things that may be a little bit more expensive could just be insurance, depending on the type of property. If it's further out, it could be property taxes. That's a lot more expensive if you, especially if you're buying a manufactured home or something like that. So there's just some things just to think about in terms of the price of the house and just the other cost of the houses in rural areas versus in the city limits.
Mm-hmm.
Yeah. One of the things I've noticed, and because I mainly work in Orangeburg, my CEO Eric right there. I mainly work in Orangeburg, so majority of Orangeburg is rural. But like when you go into your country areas or just outside of the city, one of the benefits of buying in rural areas is that you might not, you won't have that city tax. Okay.
It's true.
You won't have city tax and county tax together. So and that could be a benefit as well. Could be a pro. I do know what you mean as well, LaShawn, when it comes to, if you buying a mobile home or so, and the insurance rates could be
They're
higher.
higher.
Yeah,
Yeah, they
yeah.
are high. Depends on the age of it.
Yeah, man. Man, my background is in insurance, so like I remember I used to inspect mobile homes all the time,
Mm-hmm.
and like a lot of people were paying the same premiums for people that had like stick built houses, or higher. Actually, they were paying higher premiums, for their mobile home, and which was kind of odd, but the reason they did that was because the risk for mobile homes are higher than the
Right.
risk for a stick built house. So yeah,
Mm. When
so
you say risk, what do you mean? You mean like the risk of, like, I guess if a
ri-
natural disaster comes and
yeah, it's
there's
a
a little
reason
way.
why they tell you. It's a reason why they tell you don't stay in a mobile home when a tornado's coming.
Yeah.
Okay, and no shots.
Mm-hmm.
Please, if I hope you don't get offended when I say this, but like it's just no. They know that the structure of it could give a whole lot easier than your stick built house.
Yeah.
You know, and also the way it's built. It could be subject to damage a whole lot easier than your stick built house. So
Yeah.
yeah.
Definitely true. Another thing to take into consideration, of course, and when you're in the city, we're looking at less acreage, less land. The more you move out more rural areas, the more land you're gonna get. So I know that's very
Exactly.
important to a lot of people. A lot of people
Hmm.
don't like being constricted to those I guess you would call cookie cutter neighborhoods in a sense.
Yeah.
And some people
No.
love it.
Yeah. No HOAs.
Right, no
Some people love
HOAs.
that
Yep.
as
Uh,
well.
so yeah,
Uh-huh.
nobody telling you what you can and can't do on your land.
But I'm not
You-
necessarily against HOA. I mean, I understand, they can be a little restrictive, but I think it also helps with the upkeep. You don't have, your uncle and cousin with all their cars on cinder blocks and, bringing down the value of the neighborhood.
Hey, don't be talking about my backyard mechanic, all right?
Yeah, there's some, it depends on the person. You
That's right.
know, I've seen the pros to it and I've seen the cons to it. I see why people don't like them, and I see the benefits of having an HOA in your neighborhood. It protects a lot of times your property values. You know,
Mm-hmm.
Mhm.
man, like you said, LaShawn, you can kind of feel like a comfort to know, like, hey man, you don't got to look at certain things every day when you come home from work, or having certain things done in someone else's yard, and making sure they're keeping up their property because they're your next door neighbor. you know but in the country, it's no restrictions. So
That's
I
right.
mean, you can walk outside, next thing you know, you'll hear gunshots. But hey, that's just how it is in the country sometimes. So, but yeah, guys, pros and cons. But let's get back to like the USDA. That's the USDA, like that focuses on like rural areas, correct? If I'm not mistaken.
Mm-hmm.
Yes, it does. One requirement of SDA loans is it has to be in a rural area. And pretty much how you determine if your property is located, because it's truly based on the property and not necessarily the location itself. Like even though like we're in Somerville, all of Somerville isn't considered rural. There's certain
Hmm.
properties in Somerville that falls in USDA territory based on its location. So that particular loan, one of the great things about it that people love is that it is 100% financing. So
Mm,
what that means is that you don't need a down payment, and I say that specifically. You don't need a down payment. It doesn't cover closing costs,
That's right.
but you don't need a down payment for those loans, and it makes that particular loan program very attractive.
mm,
Usually, the interest rates are not as bad on those loans,
mm.
um, and people tend to, really, you know, can take advantage of some things there.
And down payments could range from what, LaShawn and Gavin, from you know
Yeah.
On the low end, 3%.
mm-hmm,
Um, on the high end, it could be up to 5% if it's your primary residence. If it's
yeah,
a second home or investment property, you could be looking at anywhere from 10 to maybe 15 to 20% down. So yeah.
gotcha, gotcha. What's some of the requirements for USDA loan, if you don't mind going into that?
Yeah. So one of the requirements, and I would say this as a disclaimer, it does vary by lender. I worked for various different lenders, from banks to independent mortgage companies, and usually you'll find at a bank the requirements may be a little bit more strict versus myself. We work for what we call a retail lender. So for
Mm,
us, our minimum credit score is a 600 on a USDA loan. Other places I've seen it's more so around 640 to a 660. There are income limits, meaning that your household can't make over a certain amount of money to qualify for those loans, and it does vary by the county. And so in smaller counties, it's like for example, like Dorchester and Berkeley County may have a higher income limit than Orangeburg County, just because the
mm.
cost of living is a little bit different in the two counties. So each county has their specific income limit. So for the most part, as long as you meet the credit score requirement, you meet the income limits there, then generally there's some other qualification as far as debt to income ratio and things like that. But that's getting a little too technical, and we can look at those case by case. But those are usually the basics: that credit score and the income.
Okay, okay. I I've noticed, like, from dealing with different clients, that your debt to income does have to be uh, a little bit lower, correct, when it comes to USDA. If you can go into that a little bit.
Yep. So, do you want to talk about that, Gab, or you want me to take it?
No, I'll let you go.
So yeah, so in my opinion, one of the cons to USDA loans is because you're not putting down as much money, and because we have those income restrictions and things like that, they don't allow you to borrow as much
Mm-hmm.
on under a USDA loan, versus if you were buying using a conventional or FHA loan. So usually those ratios are 29, which is your housing ratio, and then normally 41 for your debt to income ratio. And we can talk about ratios in another video.
Yeah.
But to just to make it simplified for you guys is so USDA wants to make sure that you're not overextended on your debt. So typically on a regular conventional or FHA loan, your housing payment, which is pretty much the amount of your mortgage versus how much money you make, can on a regular loan like conventional or FHA, it can go up to 45, maybe 50%. But for USDA loan, they reduce it to 29%. So what that means is that your buying power under that type of loan is very small compared to the other two.
Makes sense. Makes a ton of sense.
Mm-hmm.
One thing I want to clear up about, I think a lot of people watch HGTV, right? And
It's good TV.
I get people like, hey man, so I buy a house for 250, I can use the rest to fix up the house. Hold up, pump the
Time
brakes.
out.
Let's pump the brakes. That's a different type of loan right there.
That's
So
a good point that you're bringing up. I like this. I like where this is going.
what'd you say now? I'm sorry, I missed.
I said that's a good point, and that you're bringing up, and I like where you're going with it.
Yeah. So, and I want us to be clear about that because I know a lot of times we watch TV, and hey, they do it, and they don't tell you everything, But in this specific loan, guys, when you're buying a house with a USDA loan, it has to be in a certain condition. Like you can't buy a fixer upper with a USDA loan. Okay. Like the appraiser, let me tell you what's going to happen. The appraiser is going to come there and they have to make sure the house meets certain guidelines. And it might be something dealing with the electrical. It might be dealing with something with the plumbing. It might be something dealing with, hey, it can't have like structural issues, any rot, mold, stuff like that, that you feel like, hey, I can fix this after I buy the house. USDA, FHA, VA, they don't play. So they don't play with those. They don't play with those kind of houses. So I mean, you got other loans that are more lenient to that, conventional, but then you do have renovation loans. Okay, I hate to go down that hole, but that might be the type of loan you might be looking for if you're looking to kind of fix something up after closing. Okay, but
Right.
in this particular discussion, we're talking about USDA where the house has to be pretty much move-in ready.
Yeah, it
Okay.
has to be livable.
Yeah, exactly. So
Yeah.
I wanted to, go into that a little bit because I get that comment, get that question a lot about buying
Yeah, and I
houses.
will add to that,
Mm-hmm.
Wilmot, where you was going with that too. So, say for example, in your example, you get pre-approved for, let's say, $250,000, but the house that you're buying is only $200,000, right?
Mm-hmm.
You're like,
Oh, I
oh,
get
can I
$50,000
use that
back.
extra? They think that one, or they think, can I use that other 50,000 to make renovations on the loan? And so the answer to that question is no. So as a lender, we will only lend you based on two things: based on what the house is worth,
And the
which is
contract.
the appraised value, and then it's also based on the sales price of the house, whichever one is lower. So if you agree to only pay 200 for the house, we're only going to lend you 200. If you agreed, to only pay 300, then that's what we lend. We don't lend you above what you agreed, and we also don't lend you above what the
The
house is worth.
homeowner.
So I can't buy no furniture with that extra money. You know what I'm
No,
saying?
different loan. We don't give mortgages for furniture. We don't give mortgages for. Think about it that sense. We don't give. It's not a mortgage for that. That's a personal loan, credit card. But not a
Gotcha. And don't buy furniture. Don't get a line of credit or anything before you close on your house. Just
Yeah.
go there. Don't buy no cars before you
We
close
can't
your house.
we can't preach that enough, guys. Especially when you get pre-approved, pre-qualified, don't, unless it's been instructed or directed to you by the lender, don't go changing anything in your income, your credit, and your debt layout, your monthly obligations, because we qualify you based off of what we've seen in that moment in time. Now, and of course you gotta always be upfront. If you just went to Kmart. Well, I don't know, is Kmart still around? No, if you went to Lowe's or something to go open up a a Lowe's card or something to buy this new lawnmower, that 360 turn you wanted, and um, and it ain't hit your credit report yet. Well, we do something that's called a pre-close. You know, prior to
Mm.
you closing on your loan, we make sure that you did not open any new no any new debt obligations. You know, within the time that we started this process. So
Oh man, I can't. I hate. I if a realtor has never been through that in their real estate career, believe me, your day is coming.
It's coming.
Please. And I can't stress this. I can't tell you how close I was one time with a client, and we were right there,
right there.
and they had to go buy that car, and we couldn't get the house.
Mm-hmm.
I I hate it. You know, but
And let me break that down once you're finished. Let me break that down a little
yeah,
further.
yeah, yeah. So yeah, I mean, we couldn't move forward. And I just want people to know, like, don't change your financial situation in this process.
Mm-hmm.
I don't care what you do after you get them keys. After you close, if you want to go buy that car, go buy it. If you want to go buy that furniture, go open up that account. Do it then, but don't do it before.
Mm-hmm.
Okay.
Okay, so
Um.
this is what I would add to that. Is that I had several clients tell me this who have done this. Is they think because, oh, I don't have a payment until after closing, it's okay for me to open the debt. No. Oh, they told me, that there's no interest or whatever until next year on the credit card or something. No. Do not let anybody pull your credit. I would specifically say that. Don't let anybody pull your credit prior to you getting those keys and you're sitting in front of that attorney closing.
Yep. There we
And
go.
that goes not only just for you opening, lines of credit or or inquiring, buying a car, whatever it may be, but that also goes for I think our next topic that we also want to talk about is co-signing and co-bar. That you can't go signing for your cousin who needs some help with credit because you got good credit, and I think that's not going to be a hit against you. No, it is. We have to now consider that debt because you are a co-signer or a co-borrower to it.
Mm-hmm.
You
Mm-hmm.
know, quite too often, we have applicants or people who are looking to buy homes who may not have the income themselves. So, we asked the question, hey, do you guys have a co-signer, someone who's willing to co-sign or co-borrow for, with you, depending on the loan type or program that they're going to be doing. Um, and, a lot of times people do have, a mom or whomever that might be willing to help co-sign. Um, so, taking those things into consideration, you want to make sure that if you're going to be buying a house or if you're in the process of buying a house and you ask somebody to co-sign or co-borrow, they also need to take into consideration that this debt is now also theirs and it will be counted against them,
Mm.
in regards to a mortgage process.
Mm.
Uh,
That's good information, man. Good information right there. So I know sometimes we start talking about one thing and we jumping back and forth.
all good.
Trying Let's get back to the city and rural area before we end this because we on here probably for another couple minutes and then we're gonna call it. Hey guys, if you're watching and you got any specific questions, just
Mhm.
put them in the chat. Let us know if you got a question about a specific topic. Let us know. We can schedule that on a Teach Me Tuesday, and um we would be more than happy to talk about it. Also, I'm gonna put this out there. Myself and the Abraham team will be doing a live event at some point,
Mhm.
and we're gonna do a live event. So we want to, we're working out the details now, and we want to invite you guys to it whenever we do a live one. We'll love to, meet, do the handshake, and talk more personal in person with you. So if you got any questions about mortgages or real estate, anything of that nature, we'll be more than happy to help. USDA loans. Can I buy a rental property with a USDA loan?
That's a great question. The answer is no. So
Okay.
USDA loans are only for your primary residence, primary only. So that means
Mm,
you have to live in it, occupy it as your primary residence.
gotcha. Gotcha.
Mhm.
Gotcha.
And so what happens if I refinance it, or if I sell it, um, or if I change it into a rental property?
Mm,
Can I do that?
Yeah, so you can't have more than one USDA loan at a
mm,
time. Same thing with FHA, but I know we're talking about USDA, so but you
mm.
can't have more than one. And usually with government loans, they get kind of strict um, on those.
Government loans. Mm. That's a good one. But let's say, but I have heard though, but I know this was kind of we kind of going going to the left a little bit. I have heard people use FHA loans to possibly buy like a duplex or a triplex, and they live in there
Correct.
themselves. You
Hmm.
know, they might live in one unit, rent the other unit. I hear that as a real estate strategy, to possibly make your home an asset, a true asset by cash flowing. So,
Yeah.
Yeah,
No.
that's a very good that's a very I like to say strategic way to do
mm-hmm,
financing where
mm-hmm,
you utilize a loan program that's more favorable to
mm-hmm,
first time home buyers and things like that, and you're pretty much leveraging the units inside of that property to
mm-hmm,
one stay in it, one, and then
mm-hmm.
also to help provide some additional income for you. That's very
Gotcha.
smart.
Do USDA loans take a little longer to close than your typical loan?
They do. And so because the government is involved, it has to go through really like two underwrite
Mm,
processes. So we will underwrite the loan initially to make sure that you guys meet all the requirements of the USDA, make sure the debt to income ratio is good, the job history is there. And then after we do our piece, we have to submit that loan to USDA for approval. Now, I will give this disclaimer as well, because a lot of people call me and they get them confused. There are two different types of USDA loans. The type of USDA loan that we're talking about is called the USDA guaranteed loan. Me, a lender like Gavin and myself, we offer those loans, on behalf of USDA. There is a loan that is called a USDA direct loan, and we
mm.
don't do those loans. Those the easy way to remember that is that you truly have to apply with USDA. You'll have to go to USDA.gov and apply for that loan directly, and that's a whole different loan program. So this is for
Okay.
the USDA guaranteed loan.
So can you tell me what's the difference between the direct and the guarantee?
Mhm. So the
Okay.
guaranteed is kind of like exactly what we were talking about. The
Mm-hmm,
direct, the biggest difference there, USDA guaranteed is more so for um, low to like moderate, like middle income individuals. And
mm-hmm.
USDA direct is more strictly for really low income individuals. So people who
Oh,
may be
okay.
on a fixed income or people who may make under maybe $30,000 or $40,000 a year for their entire household. Because what they do under the direct program is they subsidize a
Mm,
portion of your mortgage payment so that they give you like it's almost like a voucher, but it's a subsidy to help cover the cost of your mortgage, which is
okay.
different. And we don't do that.
Okay. Gotcha. Gotcha. Okay. Cool. Oh man, that was pretty good. You got anything you
Good
want to
stuff.
add, Gavin, brother?
No. I mean, I think we had a successful Teach Me Tuesday. We summed it up in where we're going to be in 30 minutes. So
Mm-hmm.
I think we gave the people a little something to meditate on, and hopefully, create some questions, to some of the topics that we touched on, um, and definitely in helps of what we're going to talk about next week. So
Mm-hmm. Mm-hmm. I'm gonna repeat this quote. Hopefully I don't butcher it. It's a difference between what you can afford and what you qualify for.
that's
Mm,
right.
that's good.
That's
Mm-hmm.
good
You
stuff.
might can afford it, but that don't mean you qualify.
And I can't let you be alone. I got to drop my little quote in there. Um, what was it? Um, you paying the mortgage. You just got to determine whether you paying yours or you gonna pay somebody else's.
I like that one too. I
So,
like that one too, brother. I appreciate you guys this week. Teach Me Tuesday. If y'all have, like I said, if y'all have any questions, let us know. We'll be more than happy. Specific if it's mortgage, the Abrahams, okay? If it's real estate, you can contact me. I can answer some questions pertaining to mortgage, but I leave that to the professionals. So
Same here to the pros.
I appreciate the Abrahams for coming on for Teach Me Tuesday. Next week, we're gonna be on here next week, guys.
Yeah.
Yeah, well, same
Okay.
place.
Same place, same time. All right.
So yeah.
Appreciate y'all, and I hope y'all have a blessed week.
All right, brother.
All
Bye
right.
guys.